Hello, everyone, and welcome to our first webinar on elements of customer risk. My name is Anu Sood, and I'm the Director of Marketing at Caseware RCM and today's moderator. Here's a little bit about our presenter today. Laurie Kelly has a 35-year career spanning the fields of accounting, finance, risk management, and regulatory compliance. Most recently, she served as the Director of Compliance for CoBank ACB, a $130 billion farm credit system, where she developed and managed the bank's anti-money laundering, fraud, and economic sanctions compliance programs. She holds CAMS designation as well as the CAMS audit specialization, and she helped found the ACAMS Colorado chapter and served as the Executive Board Chair and Programs Director. With that, I'd like to pass the presentation over to Laurie.
Well, hello, everyone. And once again, welcome to the first of our three-part webinar series on the elements of customer risk. Before we get started, just a quick disclaimer. Everything I'm sharing today is from the perspective of US regulations. So if you're based outside the US, please just keep that in mind. However, most of what I'll be discussing today is relevant to everyone, regardless of locale. Today, we're going to start with an exploration of just what is risk. Then, before we go further, we'll clarify the meaning of customer due diligence and how it differs from what's commonly called CIP, which is really customer identity verification. Next, we'll explore some concepts around categorizing, quantifying, and measuring customer risk from a money laundering perspective. And then we'll go deep into a number of risk factors specific to individual and business customers within the category of customer profile data. We'll also discuss how customer relationships, both with the financial institution as well as with external parties, impacts risk. We'll wrap up with some concluding comments and then open it up for your questions. So let's get started. So when we talk about risk, what exactly do we mean? Well, there are many ways to define risk, but I like this one. To take a risk is to intentionally interact with uncertainty. And uncertainty is something that may or may not occur, which we can't predict if or when it may occur, and we can't control whether or not it will occur. We're here today to talk about customer risk. And just to be clear, in the context of anti-money laundering, it's the risk that your customer may conduct money laundering activity or other financial crimes through their account with your institution that you don't detect. So therefore, later on, when and if this activity comes to light, it could subject you to all kinds of regulatory, financial, or reputational heartache. And now let's face it, any new or existing customer has the potential to use the institution for illegal activity. That's where the uncertainty piece comes in. Now, obviously, without any customers, we'd have no risk, but we'd also have no business either. So we look for ways to manage this risk rather than eliminate it altogether. It's important to recognize that everyone perceives risk differently in any given situation. And I found this to be especially true when it comes to customer money laundering risk. As AML professionals, our world revolves around this. So it's important that we have a heightened awareness of what makes a customer a higher risk for money laundering activity. And that's exactly what we're going to dive deep into today and in the next two webinars in our series. Now, customer risk rating or risk score helps us identify those customers who present a higher risk of money laundering or illegal activity. Well, why should we do this? Well, first of all, if your institution is subject to US law, you're required to. What's commonly known as the FinCEN Customer Due Diligence or CDD rule became law on July 11th, 2016 with a compliance date of May 11th, 2018. Among other things, the CDD rule required that financial institutions should establish an understanding of the money laundering and terrorist financing risks of its customers, which the rule refers to as a customer risk profile, or what we commonly refer to as the customer risk rating or score. Now, this risk rating then points us to the customers who we should be monitoring more closely for possible money laundering activity. And because we simply can't monitor every customer in depth, we have to focus on those who present the higher potential risk. The challenge that's faced by compliance professionals is not in understanding necessarily the why of customer risk rating. I think we probably all get that. The challenging part, as with so many regulatory requirements, is how do we do it? In this webinar and the remaining two in our three-part series, I hope to give you some practical information and tools to help you figure out the how of customer risk rating. What I won't be able to cover are the aspects of customer risk rating that are unique to your institution, mainly how you actually build your customer risk scoring model, how you choose to weight certain risks or scores, and how you build customer risk scoring into your transaction monitoring software. And before we go further, I want to take a moment to clarify the difference between customer due diligence, of which customer risk rating is a part, and customer identity verification, or what in the US we commonly call CIP. And I always wish it were called CIV because that would make a lot more sense. But the CIP acronym has stuck because it stands for Customer Identification Program, which is what the underlying regulation is titled. Anyway, CIP, or Customer Identity Verification, is the very clearly defined set of requirements for verifying a new customer's identity. These requirements were established by Section 326 of the USA Patriot Act. It only applies to new customers, whether they're natural persons, in other words, humans, or they're legal entities, and to the beneficial owners of those legal entity customers. It's pretty much a one and done exercise of obtaining documentation to ensure the bank has a reasonable belief that it knows the customer's true identity. Customer due diligence, on the other hand, involves much more detailed analysis and assessment of a new client from an AML risk perspective. Usually when you're onboarding a new customer, identity verification comes first, then due diligence. And this is because if you can't verify their identity, you shouldn't even think about opening an account. Together, CIP and CDD are what encompasses KYC, or Know Your Customer. The topic we're covering today and in our next two webinars is all about the due diligence element, not CIP. So now that we've resolved that, let's move on. There are many different risk factors that come into play when assessing a customer's money laundering risk. So many, in fact, that it's logical to group them into categories. The most widely accepted categorizations are what we see here in this pie chart. Now in this chart, each risk category appears to have an equal share of the total risk, but that doesn't necessarily have to be the case. And we'll go into that in more detail a little later on. For now, let's just talk briefly about each one of the categories. The first category is customer profile and relationships. Some call this customer demographics or simply customer risk, and I find that nomenclature gets a little confusing. But regardless, it's the risk factors associated with the characteristics of that customer, and especially for legal entity customers, their relationships to other individuals and other legal entities. And it's this category that's the subject of today's webinar and what we're going to dive into shortly. The next category is products, services, activities, and behaviors. It includes all the things the customer will do or is doing through your institution. In our next webinar that's coming up on March 24th and 26th, we're going to go much deeper into this risk category. But in essence, it's about how the products and services the customer uses and their transactional activities and behaviors or patterns of behavior can indicate a higher money laundering risk. Now, if you think about it, the first category is about who the customer is. The second category is about what the customer does. And the third category, geographic risk, is about where the customer does it. It being payments, both incoming and outgoing, location of assets, business relationships, and so forth. This is then tied to the money laundering risk associated with individual countries. Now, in our third webinar of the series, which is on April 7th and 9th, I'll be describing one methodology for risk scoring individual countries from a money laundering and terrorist financing perspective. These country money laundering risk scores then come into play when you're evaluating how risky are the places where your customer is sending or receiving funds or has other significant connections. And before we get into the details about the risk factors associated with customer demographics and profiles, I want to talk a little bit more about quantifying and measuring customer money laundering risk in general. Because risk is a somewhat nebulous concept involving uncertainty, we need a way to quantify a particular customer's risk, starting with an objective model, and then, if it's appropriate, adjusting that risk score using actual experience with that customer and professional judgment. Now, most customer risk scoring models are often way too complex. And whether this is in response to regulatory scrutiny, changing perceptions of customer risk, or trying to apply lots of different risk factors by business segment, or maybe it's just a matter of overthinking the issue. But some leading financial institutions are now exploring a simpler and more holistic approach. They're doing this by creating a consistent set of risk factors and then determining the specific inputs relevant for each line of business. Now, while this is a whole separate topic of discussion, I wanted to highlight that keeping your customer risk scoring model as simple as possible while maintaining effectiveness is an important goal. Now, as I said earlier, we're not going to get into a lot of the nuts and bolts of designing a risk scoring model. That's up to you based on your institution's perceptions of risk. What I will be exploring with you today are many different risk elements that you may consider incorporating into your model. One last point about customer risk scoring, and that is the customer risk score is something that should be dynamic, meaning it may likely change and evolve over the life of that customer relationship. And that's because with a brand new customer with no history with the bank, an initial risk score is never going to be perfect, no matter how complex your model. It's going to take time to actually see how that customer behaves to develop a more accurate profile. As a very simple example, let's say we have a new business customer who has a number of higher risk factors based on elements in all three of the categories we just reviewed. Now, initially, this customer may come up with a high risk score, which typically means we're going to watch their transaction activity fairly closely to see if it matches up with what their profile indicates. If it doesn't, then after a time, we could potentially lower that risk score and therefore their corresponding transaction monitoring thresholds. And on the other hand, an initially low-risk customer could suddenly begin engaging in out-of-pattern or high-risk transaction activity, maybe even to the point of a suspicious activity report, or SAR, is filed. This low-risk customer is now high risk, and their score should once again change to reflect that. So now let's have a poll question. How complex would you say is your institution's customer risk scoring model? Go ahead and make your selection, and then I'll have Anu give us the tally.
Yes, we're just going to give everyone about 10 seconds to pick their answer. All right, so according to the people who have answered, uh, 39% said it was relatively simple and straightforward, but 39%, actually, if you combine the top two, 45% said it was either incredibly complex or somewhat complex. And only either no one understands this or some people understand it. We also have 17% who said they either have no idea, they use their AML system's risk scoring algorithm, or they're not sure. So I think it's great that 39% think it's relatively simple and straightforward.
Now we're getting ready to get into the details, and we'll start by exploring risk factors associated with individuals or consumers, as some institutions may refer to them. These are the clients who are opening depository, investment, or credit accounts for personal or household use. Now, please understand that as we talk about the different risk factors, there's no intended bias here. What we're doing as AML professionals is attempting to identify higher risk characteristics based on what's been established over time by law enforcement and financial institutions' experiences. Now we're going to do another poll question here. How does your institution collect the data needed for customer risk assessment? Now, your response, you may want to say, well, it's a combination of some of these, but for this poll question, just choose the one that is most predominant at your institution, and then Anu will share the results.
Yeah, and I think the answer will partly depend on the model of business or what kind of products and services um, the your institution's involved with. But yeah, let's just see what people have to say. Okay, so for the most part, 77%, either the frontline staff collect the data, or it's collected through the customer account application process. And only 23% have it collected by the compliance staff.
Okay, that lines up with what I would usually expect to see. So from a customer profile and relationships perspective, commercial or business clients actually have many more risk factors to consider than do individuals. And we'll get to those in the next segment. With individuals, it tends to be more the actual behavioral variables that have a significant bearing on money laundering risk. But nevertheless, let's look at these demographic factors. Remember that we're attempting to highlight characteristics that could indicate a higher risk of money laundering. And as you examine these, don't forget the three phases of the money laundering process, right? Placement, layering, and integration. The first risk factor is the channel the customer is coming through to open an account. Now, some people may refer to this as well as an interface. If your institution offers online account opening or account opening through a third party, these are higher risk than face-to-face with a bank representative. Why? Well, because of the anonymity factor. It's obviously much easier to pretend you're someone else through an online channel or to collude with a third-party account opener to hide your identity. Next, the depth and length of the customer relationship can be a mitigating risk factor. This means a customer that has multiple account types like checking, savings, credit card, mortgage, consumer loan, etc., has a deeper relationship with the bank than a customer with only one account. Also, having an ongoing customer relationship for a certain period of time, let's just say 3 to 5 years or more, can also be a moderate mitigating factor. Now, both of these, depth and length of the relationship, are a mitigating factor because they reduce that uncertainty element. In a customer risk score model, mitigating factors get a negative point value so that they slightly reduce the overall risk score. There are also certain risk factors relating to a person's employment status. An adult client who has no employment warrants some further exploration as to find out why. Also, self-employed people may present a slightly higher money laundering risk because of the potential to commingle business funds and transactions within a personal account, or vice versa, in an attempt to hide or distort activity to evade taxes. And I actually saw this a lot during my years in compliance. Also, a client who reports that their employer pays them in cash is a very high risk initially, especially for placement of illegal funds. With certain types of accounts, the client's assets and sources of wealth may also present higher risk factors. If they appear to have assets beyond what you'd expect based on their employment history, or if they list unusual or irregular sources of these assets and the explanations they provide can't be sufficiently verified, then their risk score should reflect this. Citizenship status and residence are also important risk elements for individuals. A person with non-resident alien status is a higher potential risk than a citizen or a permanent resident. Also, a person opening an account at a bank location that's significantly distanced from their place of residence or employment might be higher risk. Why? Well, individuals who act as money mules for illegal activity like drug sales or human trafficking often open accounts at many different branches or separate banks within a wide radius of where they live or work in order to break up large cash deposits into smaller and less noticeable transactions to avoid suspicion and cash transaction reporting. Also, an individual who's considered a politically exposed person, or PEP, is also significantly higher risk. Sometimes we refer to these as senior foreign political figures, and they're a person with a high-profile current or former political role, or someone who's entrusted with a prominent public function. Some financial institutions would even consider the spouses and adult children of these individuals to be PEPs as well. PEPs do represent a higher risk for financial institutions because statistically they're more likely to become involved in money laundering, corruption, bribery, or terrorist financing. So how do you see or check to see if someone is a PEP? Well, there are several ways, but many AML software vendors publish a global list of PEPs along with their direct relatives and associates. And that way you can automatically screen customer names against this list as you would do for OFAC screening, say. In terms of relationship risk factors, the most significant for individual accounts is when several people who have no apparent family relationship are joint account holders or have signing authority. Now, oftentimes, this scenario can mean a human trafficking or elder abuse or even a fraud situation is involved. Or it could be a red flag for a funnel account. Now, a funnel account is opened at one bank location and receives multiple cash deposits from different people, often in amounts that are below the reporting threshold. Then money is withdrawn from the account from a totally different bank location, often in another state, with very little time between the deposits and the withdrawals. Anticipated transaction activity is another important risk factor for individuals, and it will impact the second major category of risk, which is products, services, activities, and behaviors. Now, I choose to categorize anticipated transaction activity as a customer profile risk factor because it's what the customer is telling us they plan to do with their account. If frequent cross-border wire transfers or frequent cash deposits are something the customer says they plan to do, then this should be considered a higher risk element of the customer's overall risk score, indicating their account just merits closer monitoring, at least initially. So if you're like most compliance professionals, you love a real good real-life case involving money laundering or fraud. So here's one for you that emphasizes how a client can seem to be golden, but really isn't. This is the case of a man named Talal Shaheen. And Mr. Shaheen is a naturalized US citizen, originally from Lebanon. He's a self-made man, prominent businessman in the greater Detroit area who founded a successful restaurant and even turned it into a franchise. He's highly regarded in the community and represents himself as an honest businessman with deep family values. And what a great smile. Now, let's say he's a client of your bank. He has several personal as well as business bank accounts, along with a commercial line of credit for his business and a mortgage on his home. He also uses your bank's investment services. Any reason to think he'd be a high-risk client? Well, probably not. He's well known and well respected. He has a legitimate business that's very successful, and he has a deep relationship with the bank with all of his different accounts and services. But here's what was really going on with Mr. Shaheen. Over a 4-year period, he designed a scheme to skim cash proceeds from the restaurants in order to evade income taxes. Authorities estimate over this period close to 20 million was skimmed and concealed using a double set of computerized books, one real and one cooked, if you'll pardon the restaurant pun. The cooked or altered books were produced by a complex computer program that artificially reduced the amount of cash receipts actually received by the restaurants. So of course he needed to hide all that cash from the IRS. And he did this using predominantly three different methods. First, he had employees take cash to the bank and convert it into cashier's checks that were then sent to people he knew in Lebanon. Second, he'd have employees take batches of cash in small bills and exchange them for large bills in order to make it easier to smuggle the cash out of the US to Lebanon. And third, he paid all his employees in cash. I guess so they could evade income taxes too. What a great boss. And if that's not enough for you, court documents indicated that Mr. Shaheen had connections at the highest levels to the foreign terrorist organization Hezbollah. There's even a photo of him sitting next to Sheikh Mohammed Fadlallah, a Hezbollah leader who's on the OFAC terrorist list. While Mr. Shaheen remains a fugitive today from US authorities and he's believed to be in Lebanon, his wife wasn't so lucky. She got caught and pled guilty to assisting Shaheen in his tax evasion scheme. She got 18 months in prison and hopefully a divorce. Now we're going to switch gears and talk about risks associated with business or legal entity customers. This includes everything from sole proprietorships to closely held corporations, nonprofits, and even trusts. Business or legal entity customers, as I said before, have a significantly greater money laundering risk than do individuals or consumer customers. Well, why is this? The main reason is that a legitimate business provides the perfect cover for money laundering activity, all three phases of it. International narcotics trade, cybercrime, human trafficking, and financial fraud are all benefiting from the use of legitimate businesses as a means to launder their proceeds. What you see here are the most significant established risk factors relating to the demographics or characteristics of legal entities. Now, in the next several slides, we're going to explore each one of these in greater detail. First, let's take a look at risk factors surrounding how a legal entity is structured in terms of ownership and form, as well as the level of third-party oversight of the entity. In essence, the less transparency in ownership and structure, the greater the risk. When the individuals who are actually behind a company directing its activities, perhaps illegal activities, want to clearly remain anonymous. A complex ownership structure and complex legal entity type both afford this kind of anonymity. This is also where we see shell companies come into play. A shell company, usually an LLC or limited liability company, is one with no real physical presence and no actual business purpose, and other than to just be one layer in a complex structure intended to make it very hard to decipher who's really in charge and what they're really doing. Now, trusts can also be especially risky. According to the US Internal Revenue Service, abusive trust arrangements can hide the true ownership of assets and income or disguise the substance of transactions. The degree of third-party oversight is also an important risk factor. But why? Well, because without it, nobody's looking at what the business is doing on a regular basis. This oversight could be external, such as a regulatory authority. Think of how the Securities and Exchange Commission has oversight of publicly traded companies in the US. There's also internal oversight, which comes in the form of an internal audit staff or an independent audit of published financial statements. Now here's another poll question. As part of your due diligence on business entity customers, do you obtain an ownership organization chart? Go ahead and provide your answer, and then we'll hear from Anu with the results.
Yeah, it'll be interesting to see what are people's experiences with the ownership organization chart. Now, I imagine there are a lot of factors when a person is deciding whether they need one. But it'd be nice to see what kind of trends we're seeing across the industry. Okay, so almost half of people said yes. About 47% get an organizational chart, 25% say no, and 28% say sometimes. So I imagine it really depends on the customer, where um, if it's a single proprietor, you may not need an organizational chart? Um, I don't know. What other factors do you think might affect?
Yeah, it depends on how, obviously, how complex the entity is, um, and whether it's directly owned by individuals, which you could stop there because it's owned by individuals, or if there are layers of companies involved. So it just
Exactly.
depends. Yeah.
Yeah. Okay,
Okay.
good.
Now I want to take a moment to talk about two particular red flags to be alert for when you're performing customer due diligence on a legal entity. And these do fall under the umbrella of ownership and legal structure. The first one relates to the use of what we call nominee incorporation services, or NIS firms. Sometimes we call these corporate formation agents. These exist throughout the US and around the world. And while they do serve a legitimate business purpose, they are often used to create shell companies, making them appear legitimate and hiding their true owners. They can, in the US, legally form a new company in any state. These companies also provide all kinds of services, like a physical address, a telephone number, and someone to answer it in the name of the company, maybe even a letterhead, and all kinds of other services to make a shell company appear to be legitimate. But what's really insidious are what are called nominee officers, directors, shareholders, or bank signatories that an NIS firm can arrange. A nominee is just an ordinary person who gets paid for the use of his or her name in place of the actual company owner. So the owner's name is kept out of any public record. Now, these nominees' names could, to my understanding, even be included on a beneficial ownership form provided to a financial institution in place of the real owner. The nominee arrangement is built on a very complex power of attorney relationship. Now, law enforcement investigations over the years have found nominees who are listed as the owners of literally thousands of companies, and it's all perfectly legal. So what are some ways you could discover whether your business customer is using an NIS firm and may therefore actually be a shell company? The quickest way I found is to just do a web search or Google search of the company's address. If the search results come up with entry after entry of different company names, all with that same address, it's very likely you've got an NIS firm involved. Also, do a web search or even a background check through a service provider on the beneficial owners and see if what comes up makes sense. The second set of red flags relate to where the entity is domiciled, meaning where it's incorporated. Now, if the business's primary operations are not in the state of domicile, you'll want to find out why. Be especially cautious when the domicile state in the US is Delaware, Wyoming, or Nevada, as these states are the most notorious for anonymous corporate formation. There's a pretty high probability that an NIS firm is involved when companies domicile in these states as well. So do that web search on the physical address to check. Finally, any company with an offshore domicile, especially one that's considered a financial secrecy haven, should be very closely scrutinized and initially considered high risk. These images here reflect the magnitude of anonymous corporate formation in the US, especially in Delaware and Wyoming. In 2018, there were over 216,000 new legal entities formed in Delaware, bringing the total of all companies incorporated in Delaware at the end of that year to 1.4 million. And I find this astounding considering the population of the state is only about 967,000. In the lower right is a nondescript building in Wilmington, Delaware, which over 285,000 companies list as their corporate headquarters. It's actually the office of CT Corporation System, also known as Corporation Trust Company, and it's one of the largest NIS firms in the United States. Now in the lower left, you see a little house in Jackson, Wyoming, which happens to be the headquarters of over 5,000 companies. Reuters published a fascinating report on the use of NIS firms and shell companies that happened to feature this particular one. Now let's talk about some specific industry risk characteristics. Cash-intensive businesses have a much greater propensity for facilitating the placement of dirty cash into the financial system. Because their sales are primarily in cash, funds from illegal activities can easily be commingled with deposits from their legitimate receipts. They may also routinely make very large daily cash deposits and may result in qualifying for a cash transaction exemption. Most of these cash-intensive business types listed here are what you'd expect. A couple of them are basically in the business of cash, so to speak. For one, money service businesses, or MSBs, effectively convert cash into another form, like wire transfers, money orders, traveler's checks, or even stored value cards. Their customer base can be very transient, and the transactions they're conducting offer a fairly high degree of anonymity with minimal documentation needed. Private ATM operators are another type of cash processor with a high money laundering risk. These are the ATMs, or automated teller machines, that you often see in convenience stores, gas stations, and other small retail locations. They're privately owned rather than by a bank. The machine's owner provides the cash for the machine from their own funds, and then they're reimbursed by a payment processing service minus a fee, which is why they charge you a bigger fee to use the machine. Now, these businesses are regulated in the US by state banking agencies, but they're really difficult to oversee and control. So how are private ATMs used for money laundering? Well, a money launderer buys machines and puts them in various locations. Sometimes the businesses where they put them may even be co-conspirators. The launderer loads his ATMs with illegal cash or commingled with clean cash. Then ordinary people like you and me use the ATMs, and the electronic transaction process debits the cardholder's account and credits the ATM operator's bank account. These transactions then appear as electronic deposits from a legitimate financial institution, thereby effectively laundering the illegal cash. Now let's talk about foreign business activities. As a part of your customer due diligence process, you should definitely ask about a business client's anticipated cross-border transactions and what is their source. Most often, it's going to be import or export activity. Now, historically, import and export activity was the domain of the big corporations, but in today's global economy, many small and medium-sized businesses are actively involved in international trade. Now, there are always risks involved when you're dealing with an overseas counterparty. So traditionally, buyers and sellers would use commercial letters of credit, or LCs as we would call them, that are issued by banks. The documentation that's required to issue and collect funds under an LC makes sure that both parties' interests are protected, and it provides a complete paper trail of the transaction. But these protections come at a price in the form of bank fees, which reduce the importers' and exporters' overall profits. So to avoid the additional cost of letters of credit, many exporters have gone to what's called open account trading. Under open account trading, the seller just invoices the buyer for the amount of the shipment, and payment is made directly from the buyer to the seller, usually by wire transfer. So without an LC, there's no independent set of eyes examining the transaction, and this in turn facilitates two particular types of money laundering. Trade-based money laundering through over or under invoicing, and something called the black market peso exchange. Now, both of these are way beyond the scope of today's presentation, but I'd recommend you do some further research on your own to learn more about these money laundering methods, especially if you have business customers involved in import and export. For those of you in the US, another type of high-risk cross-border activity is transportation of goods across the southwestern US border with Mexico. And that includes California, Texas, Arizona, and New Mexico. This region is designated as a high-intensity drug trafficking area by the U.S. Office of National Drug Control Policy. Now, any commercial client who operates in any part of this region should be more closely scrutinized for potential money laundering and other illegal activities, no matter what the nature of their business. Pay close attention to who are their Mexican counterparties, their volume of cash-based transactions, and any business operations they may have within Mexico. Similarly, MSBs that operate in the same region are also considered higher risk. They're often known as casas de cambio or exchange houses. You may recall how one major US financial institution got into some pretty serious trouble several years ago for banking casas de cambio that were directly involved in a multinational narcotics money laundering scheme. Before we get into another case study, I'd like to offer you some food for thought. And full transparency here, these comments I'm about to make are entirely my own opinion, based on nearly 20 years in anti-money laundering with a financial institution that served only business clients. I'd like to share with you something I call the respectability factor and what it means for customer money laundering risk. So it's been well established that money laundering commonly involves getting proceeds from illegal activity into a legitimate, respectable business in order to make it appear normal and legal. It also involves techniques developed for legitimate business purposes, such as cash management services, lockbox receipts, and maybe even private ATMs like we just talked about. Then, professional service providers like attorneys, accountants, and financial advisors may also get involved in the money laundering process, either directly or just by looking the other way. The thing is, the more profitable organized crime becomes, the more important it is for them to find ways to shift profits into legitimate activities. They need a reliable legal income. Otherwise, their lifestyle will eventually attract the attention of law enforcement and tax authorities. If you think about it, you can't sustain a luxurious lifestyle without spending a large amount of income on goods and services. So they have to make this income appear to be from a legitimate source. Throughout my years in AML compliance, I came to a conclusion that the quote unquote family owned and operated gold standard of respectability can actually be a red flag for a financial institution. In other words, it often represents a closely held entity where there may be little to no controls or oversight of the business's financial dealings. And what I believe this means for a financial institution is that a business customer's respectability factor can no longer be a mitigating factor in a customer's money laundering risk assessment. And this is because money laundering, fraud, and other illegal activities are increasingly being committed through legitimate businesses with long-standing favorable reputations. As well, they're often involved in traditional or well-respected industries, and they may be located in what are perceived to be very safe, rural, or smaller urban areas. In my opinion, it's precisely these characteristics that make them perfect hiding places for illegal activities. So just think about all this and you can draw your own conclusions. Next, I'm going to present a case study that illustrates a business customer with multiple profile and relationship risk factors. And you should know that this is based on an actual customer of my former bank. I've changed or omitted certain things for anonymity, of course. And this case study is about a company called CAT International, Inc. They're headquartered in Yuma, Arizona, run by just a husband and wife team with just 2 other employees. And they're a type of cattle brokerage that arranges for live cattle to be driven from the state of Chihuahua, Mexico, into the United States. Chihuahua, which is just south of New Mexico and parts of Texas, is the largest cattle producing region in Mexico. And since 2010, high US cattle prices combined with a prolonged drought in the southwestern United States have resulted in a large and growing level of US imports of Mexican cattle. Chihuahua also happens to be a major center of the Mexican drug trade. In fact, Ciudad Juarez, which is one of Chihuahua's largest economic centers, sits right on the border with El Paso, Texas, and it is considered to be one of the most dangerous places in the world due to drug cartel violence and political and law enforcement corruption. Now, CAT International's business model is this. They pay Mexican individuals a per head, as per head of cattle, fee to drive herds of cattle across the border into the US. And these payments are typically anywhere from $10,000 to $20,000 per person. They're in the form of US dollar wire transfers that are sent to these individuals through Mexican casas de cambio. Amazingly, CAT International has reported annual gross income of $20 million or more per year in recent years, which is not bad for a mom and pop shop. So what are our risks with this small family-owned business customer? Well, for one, I always thought that these massive cattle herds being moved into the US would be a really convenient way to smuggle drugs in from Mexico. And I'll just let you use your imagination with that one. Next, the company is routinely making pretty big payments by wire to unidentifiable people in Mexico who don't even have bank accounts. The money's going to some casas de cambio where these guys are picking it up. It's not even going to an actual bank. Remember, a casa de cambio is a money service business. Add to all this the fact that they're operating in one of the most dangerous and prolific illegal drug production areas in the world, and they're making a ton of money doing it. Is this risky? Well, I would say so. Now, we've touched on relationships several times throughout our discussions of individual and business customers, but it's worth spending a moment just to summarize what we mean by relationships as a risk factor. With both individuals and business customers, there's a risk mitigating factor, a slight risk mitigating factor, I should emphasize, in terms of the length of the customer's relationship with the institution. The longer they've been with you, the more history you have on them. And you can see their normal patterns of behavior. And then when something abnormal occurs, it's going to be much more obvious. How long they've been with you should be a factor that can slightly reduce their risk, all other things being equal. Generally, 5 years is considered a good threshold. Now, with respect to a customer's external relationships, we see different types of risks with individuals versus business customers. As we talked about previously, with individuals, the key risk factor is something we touched on earlier, where when more than one person is an account owner or a signatory, and there's no family relationship between them. This could be an indicator that something isn't right. It could be a funnel account where, as I spoke about earlier, funds from multiple money mules are being centralized. Or more and more, we're seeing cases of human trafficking or elder abuse where an account in one person's name, the victims, is actually controlled against their will by another party. So if there's no good explanation, then the account should be considered higher risk and monitored more closely. When you're conducting due diligence on a business customer, look for any relationships between seemingly unrelated entities where the common thread is the beneficial owner or owners. For example, say your bank has accounts for 3 businesses, all LLCs, as you see in this diagram. We have a trucking company, a dry cleaner, and a nail salon. These are all very different businesses, and on the surface, you might think there's no way these 3 entities could possibly be related. They're all owned by other LLCs. But by matching up the data on the beneficial owner of these entities, you see they're very much related because one guy has ultimate control of all of them. And that guy, Bob Smith, has no relationship with your bank. If these interrelationships haven't been disclosed or flagged, there's an increased risk here of undetected suspicious funds movement between the entities or between the entities and the beneficial owner. In my opinion, this is one of the great things about having beneficial ownership data, as long as you can capture it electronically and use it for analytics and transaction monitoring. You also want to determine if your business customer has any foreign connections, meaning subsidiaries, a parent company, or other affiliates. If they do, assess the risk of the countries where they're domiciled. This, by the way, is the topic of the upcoming third webinar in our series dealing with geographic risk. But for now, recognize that these kinds of relationships have the potential for illegal funds movement in or out of the country under the guise of intercompany transfers. So, we've explored many different risk factors today that you may consider incorporating into your customer risk scoring model. I'd like to wrap it up now with some general recommendations regarding risk scoring models. As I mentioned at the beginning, you should consider keeping your risk scoring model as simple as possible so it's clear and logical and relatively easy to test and modify as needed. However you choose to build your model, make a formal record of how the model is designed, what is your rationale for including specific risk factors, and why you've chosen to weight them differently if you do. Good documentation provides a clear reference that can be shared with your regulators, management, internal audit, and as well, all relevant compliance staff so they understand it. And along those lines, be sure to educate your frontline staff about customer risk factors so they understand how to help protect the institution and even do a bit of the due diligence themselves. It's important that they understand not just what the risk factors are, but also why. This helps them better understand money laundering risks in general. Next, it's very important to find ways to make sure customer information on which your risk scoring model depends is kept up to date. This ensures each customer's risk score evolves as things change. For example, changes of address, new foreign activity, or worst case SAR filing are all things that may or should change a customer's risk score. And it can go both ways. A simple example of this is if your model has a risk mitigator element for length of relationship. At my institution, we applied a negative point value, which in effect lowered the overall score slightly when a customer reached the 5-year anniversary of their first account opening. And it was important that this occurred dynamically rather than manually. So we worked with our AML technology vendor and our own IT group to make that happen. It's important to use and, if necessary, enhance your AML technology. A good AML monitoring system should be able to incorporate machine learning so it knows when something changes and either alerts you or updates the risk score automatically and alerts you. Finally, I want to reemphasize strongly that no single risk factor exists in a vacuum. All the risks we've explored today should be considered together along with the activities and behaviors, geographic risks, and products and services risks that we'll be talking about in the next 2 webinars. And most important of all is to take all these risk factors and consider them in the context of actual customer behavior. Having a customer risk score but not monitoring customer activity is rather pointless, just as is monitoring transaction activity without risk scores to target the customers who you should be watching the most. I'd like to thank you for participating in today's webinar, and I hope you'll join us for the remaining 2.
So with that, I'd like to thank Laurie for today's presentation, and this now concludes our webcast. I hope everyone has a great day.